That salary to equity conversion sitting on your cap table just created a dual liability that will cost you between $2 and $5 million in Series B holdbacks, and your lawyer probably thinks it's clean. Here's what 73% of founders raising their Series B don't realize about their early compensation deferrals. When you traded unpaid salary for equity without proper documentation, you didn't eliminate a cash obligation. You created what investors call dual liability exposure. You issued shares that dilute your cap table, and you may still legally owe the underlying wages as enforceable debt. Now, this isn't for founders doing their first equity grant or companies raising under $5 million. This is for repeat founders who think they understand cap table mechanics but missed the compliance gap that kills institutional deals. IRC Partners has tracked 127 Series B transactions where salary conversion defects triggered price adjustments averaging 1.8 million or deal termination entirely. The counterintuitive reality is this. The problem isn't that you took equity instead of cash. The problem is that sophisticated investors price undocumented conversions as structural liabilities, not founder compensation history. So I'm going to walk you through exactly why 5 missing documents create 4 independent legal exposures that compound into deal risk no Series B lead will ignore. The 5 documents that make conversions legally valid. A clean salary to equity conversion requires 5 contemporaneous documents that must exist at the time of issuance. Most founders have 0 to 2 of these 5 elements, maybe. First, a written agreement documenting the exchange terms signed by both parties before shares are even issued. Second, a board consent specifically authorizing the share issuance that predates the grant date. Third, a defensible fair market value for the shares, typically a current 409A valuation or documented FMV basis. Fourth, documented reliance on a securities law exemption such as Rule 701 under the Securities Act of 1933 or Section 4A2. And fifth, a written release of the underlying wage claim signed by the recipient. IRC Partners has reviewed over 400 cap tables where founders assumed their informal salary deferrals were properly converted to equity. In 73% of cases, at least 3 of these 5 elements were missing entirely. The cap table entry exists, but the legal foundation doesn't. And here's what most counsel miss. Each missing document creates independent legal exposure that compounds during diligence rather than collapsing into one single fixable issue. How Section 409A creates immediate tax penalties. Under IRS Section 409A, equity issued at a price below fair market value triggers deferred compensation treatment with immediate income inclusion and a 20% additional tax penalty for the recipient. If you converted salary to equity without a current 409A valuation, establishing fair market value at the grant date, the pricing basis cannot be reconstructed after the fact. The IRS doesn't accept retroactive valuations or informal pricing methodologies for 409A compliance. When Series B investors discover missing pricing support, they assume 409A exposure exists until proven otherwise. The penalty hits the recipient, not the company directly. But investors treat 409A violations as evidence of systematic compliance failures that extend beyond equity administration. They question whether your legal and finance functions can handle institutional capital requirements. Companies that issue equity below fair market value without 409A safe harbor documentation create tax liabilities for recipients that may not surface until the next taxable event, often the Series B transaction itself. Securities law exemption that most founders miss. Every share issuance is a securities transaction that requires either SEC registration or reliance on a valid exemption. For salary to equity conversions, the most common exemptions are Rule 701 for employee issuances, Section 4A2 for sophisticated recipients, or Regulation D for private placements. Each exemption has specific requirements that must be satisfied at the time of issuance and documented contemporaneously. Rule 701 requires the company to deliver disclosure documents to recipients and limits the aggregate amount that can be issued under the exemption. Section 4A2 requires the recipient to be sophisticated enough to evaluate the investment risks. Reg D has specific filing and disclosure requirements. Informal conversions typically fail to identify which exemption is being relied upon or whether its conditions were actually satisfied. Series B investors treat missing exemption documentation as potential securities law violations that create regulatory risk for the company and liability risk for the transaction. Now, here's the compliance gap most startups miss. Assuming an exemption applies is not the same as documenting reliance on that exemption at the time of issuance. Why dual liability creates balance sheet risk? Without a written release of the underlying wage claim, the salary obligation may survive as enforceable debt even though equity was recorded on the cap table. This creates dual liability exposure where the company faces both equity dilution from the issued shares and contingent cash obligations from the unreleased wage claims. You issued shares that count toward your fully diluted cap table, but you may also owe the original salary amounts as legal enforcement debts. Now, employment law in most U.S. jurisdictions treat unpaid wages as continuing obligations unless formally released through written agreements. A handshake understanding or verbal agreement to convert salary to equity does not eliminate the underlying employment contract or wage obligations. Series B investors treat surviving wage claims as off-balance sheet liabilities that affect deal pricing, working capital calculations, and the representations the company will make at closing. The Investors' Council will require either proof of formal releases or disclosure of contingent wage liabilities. When multiple founders or employees have unreleased wage claims, the aggregate exposure can reach $500,000 to $2 million in companies raising Series B rounds. How Series B investors price cap table defects. So Series B investors don't treat undocumented salary conversions as compensation history or administrative oversights. They treat them as a structural defect in the cap table that affect ownership calculations, dilution modeling, and deal representations. When investors discover salary conversion defects during diligence, the analysis focuses on three areas: cap table accuracy risk, where improperly issued shares make the fully diluted count unreliable for pricing purposes; dual liability risk, where unreleased wage claims create contingent cash obligations that don't appear on financial statements; rep and warranty risk, where defective issuances make standard equity representations false unless disclosed or cured. Now, the National Law Review noted in its October 2025 analysis of NVCA models that investors are increasingly requiring regulatory health checks on equity history as standard pre-close diligence. Salary conversion defects are among the top 5 cap table issues that trigger deal-specific protection mechanisms. IRC partners tracked 127 Series B deals where salary conversion issues were discovered during diligence. In 89 cases, investors required price adjustments averaging $1.8 million, escrow holdbacks of 15% to 25% of founder proceeds, or deal termination entirely. The pattern investors fear most is multiple undocumented conversions across different time periods, which signals systematic equity administration problems that extend beyond salary deferrals. Board approval requirements that cannot be retroactively cured. Board consent for share issuances must predate the grant date and cannot be retroactively validated through amended resolutions or backdated documentation. Corporate law requires board authorization before shares can be legally issued to any recipient, including founders converting deferred compensation. A board resolution dated after the fact may cure record-keeping deficiencies, but it doesn't make the original issuance valid if proper authorization didn't exist when shares were granted. The timing requirement creates a specific compliance trap for salary conversions that happen incrementally or informally. Now, founders who issue themselves shares based on accumulated unpaid wages without board approval at each conversion create defective issuances that require legal remediation or investor disclosure. Series B investors review board minutes chronologically to confirm that share authorizations predate issuance dates in the cap table. Now, gaps in this timeline trigger questions about corporate governance and equity administration that extend to option grants, warrant issuances, and other cap table entries. Companies with systematic board approval gaps often face requirements for legal opinions, remediation memos, or disclosure schedules that add $50,000 to $200,000 in transaction costs and 30 to 60 days to closing timelines. Pre-diligence audit process for salary conversions. Now, before opening your Series B data room, complete a 7-step audit of every salary to equity conversion with startup counsel and your finance team. Step 1, identify every arrangement where founder or employee compensation was deferred and converted to equity by pulling payroll records, board minutes, cap table entries, and email communications. Step 2, confirm written conversion agreements exist for each instance signed at or before the time of exchange. Step 3, confirm valid board consents authorize each share issuance and predate the issuance date shown in your records. Step 4, confirm contemporaneous 409A valuations or documented fair market value basis existed the time of each grant with no intervening material events. Step 5, confirm the securities exemption relied upon for each issuance and verify conditions were satisfied. Step 6, confirm written releases of underlying wage claims were executed by recipients. Step 7, for any identified gaps, prepare disclosure memos explaining the issue, steps taken to address it, and remaining exposure. Now, this audit typically reveals that companies with clean cap table entries have significant documentation gaps in the underlying transactions. The cap table reflects what happened, not whether it was legally valid when it occurred. Proactive disclosure with counsel-prepared memos reduces investor pushback by 78% compared to discovery during diligence, according to IRC Partners deal tracking data. Cleanup strategies when documentation is missing. Now, not every salary conversion defect can be fixed retroactively. Some require disclosure, deal protection, or legal remediation strategies. Curable defects include missing signatures on agreements where the parties can confirm the original terms, board consents that can be ratified and the underlying authorization was valid, and exemption documentation where the exemption conditions were actually satisfied at the time. Uncurable defects include pricing that was below fair market value without a 409A protection in place, securities exemptions that were never actually relied upon, and wage releases that were never executed by recipients. When material exposure cannot be cured, your options are legal cleanup through counsel before investor outreach, disclosure scheduling in financing options so investors accept the risk with full knowledge, or deal term protection where investors require escrow holdbacks, price adjustments, or legal opinions as closing conditions. IRC Partners data shows that proactive cleanup costs $25,000 to $75,000 in legal fees, but prevents investor-imposed remediation that typically costs $100,000 to $300,000 and extends closing timelines. The worst outcome is investor discovery of undisclosed defects, which destroys confidence in management representations across the entire deal. Sophisticated investors prefer founders who surface issues proactively rather than companies where problems emerge during diligence review. Now, the diligence question isn't whether you morally earn those shares, it's whether you can prove document by document that each issuance was valid when it happened. Series B investors are pricing off your cap table, relying on your equity representations, and betting you'll survive legal scrutiny through closing and beyond. Undocumented salary conversions touch all three areas and create dual liability exposure that sophisticated capital treats as structural risk, not administrative oversight. So if your raise is $5 million or above and you want to know if your deal is institutionally ready before you sit across from the right LPs. Click the link in the description below. Set up a time to speak with our team. We review your structure, your terms, and your capital stack before you walk in the room, because you only get one chance to do it right.